Hey everyone, welcome to another episode of Max Moving Training Podcast. Today we have the honor of having Brock Hartzler from Promover Accounting. We going into the numbers, y'all. Hey Brock, how are you?
Good. How are you, sir?
I'm good, I'm good. So you want to tell people about yourself? What you
Yeah,
do?
yeah, sure. So I am a partner here at Promover Accounting, a founding member. Love accounting. Not many people do. You got to love it to be a part of it. But we really have been able to dig into the weeds and really find something special. And we love to do it day in and day out. We provide our clients a lot of necessary information, and we have awesome clients. So definitely enjoy it. Again, we only serve the residential moving community. So
Nice.
a lot of guys you've had on your podcast, I'm very, very familiar with, and some guys in your Facebook group as well. It's cool to see some clients in there and people we've been able to work with in the past.
Awesome. So why you choose this small niche?
Yeah. Yeah, well, I've been doing accounting for a long time now, and I started out at a CPA firm. I was doing auditing for governments and municipalities, so I really learned a lot about financial analysis and good ways and bad ways to do things through that. That's kind of where I really kicked off a lot of what we use even today in Promover Accounting. And then after that, I worked with a local family company, Hartzler Family Dairy. We process glass bottle milk. Actually, you don't see that too often
Oh
anymore.
no, not no
And
more.
yeah, so I operated that for a little while and really changed everything in the accounting software. And again, built metrics and everything. So I have a lot of experience outside of the residential moving community. But then Tim Krupp, a good friend of mine
Mhm.
and partner as well, my late father at the time, and I would work on his taxes and his bookkeeping and such. And he came to me and said, "Hey, you know what? I think that what we have built for Krupp Moving and Storage, which is his company, is something that a lot of movers would benefit from." So Promover was born, and it's been an awesome ride ever since.
Yeah, ain't that always the case where people like, yo, I think if you went this way, it would benefit, and then it just becomes a dream.
It does, and it's been absolutely wonderful. And we've learned so much more than just numbers about the residential moving community as well. And it's been very, very good. Now, maybe not quite as much about marketing as Mr. Bloom you had previously. That guy knows his stuff, but we know a lot about the different sectors surrounding the accounting and enough to put it all together and really come up with really awesome target metrics and stuff for our clients to see and start making some decisions on. So
Gotcha. So would you say one should focus heavily on the metrics if they're trying to run their business, or is it something where it's like you kind of need to have eyes on it as well?
yeah, so there's a few different phases that a lot of residential moving companies and just companies in general go through. Okay. And the big one first, specifically for companies that are doing under 2 million a year in revenue.
Mhm.
The big thing that they need to focus on is my pricing accurate? Is my gross profit accurate? What's my overhead? It's really the 30,000 foot view of things. And once you establish what your targets are for those certain things, then really it's just a monthly check-in, right? It's how am I doing? Again, we want to look at over a period of time. We don't necessarily only want to look at last month and say, okay, well, last month my gross profit was great, I'm awesome, I don't have to look at my finances again for the next 6 months. It's a culmination of looking at previous month and making decisions, but then also looking at a 12 to 13 month average and saying, okay, where am I trending, right? Because gross profit is really based on how am I pricing my services for the direct inputs that I have for my company. And once you set those and you realize that your gross profit's strong, you don't have to tweak them too often, right? You're going to be tweaking your pricing quarterly, monthly, and annually, just to make sure that you're staying in the trends of how the year works. Right, we're in May, we're getting into the busy season. People might be increasing their prices now that jobs are really coming in, and the services are starting to increase in volume. But keeping track of, okay, how is my gross profit running? Am I able to stay profitable through the slower seasons and build up enough cash flow by the end of the busy season to sustain through that slower season? That's the reporting that every company owner, whether it's moving or not, should be looking at every month, bar none. It allows you to catch things that you may not know, but then also being able to spot targets or trends that are going in a poor way, fix those as soon as you can before it gets too far to where you have to make major changes, right?
So I know we had a little conversation about profit first, very briefly before starting this meeting.
Yeah.
And I guess, what is your take on a kind of like, I guess, pay yourself first, pay the business second type of thing?
I love it. I love it. So I have a lot of people that a lot of clients that have mentioned profit first. And the idea is awesome. So for the people that don't understand profit first, basically what it is I want to walk away with so much money at the end of every month, end of every year, or period, whatever it is, so much money or so much percentage of net, right? So much percentage of sales. Therefore, because that's what I want, I'm going to make these decisions to allow me then to walk away with that much profit. And in theory, it's wonderful. I want to walk away with $100,000 a year, in take home, whether it's through salary or owner's draws or something. Okay, well, that's fantastic. But if your company does $100,000 in sales, I can guarantee you're not going to get there, right? Now, if you're doing 10 million, okay, it's probably not, that's a pretty easy goal to hit, if you want $100,000 wage. The difficult thing is how profit first is sold it's sold very simply. It's sold, you deserve to get paid first, and therefore you keep behind what you want and determine, okay, then I'll pay my laborers next and I'll pay my overhead expense next and all that stuff. The idea is great, as I mentioned, but we here at Promover, we change it a little bit to say, yes, we want to focus on the desires of our wages and what we want to walk away with. But keeping that in mind, let's then start at the beginning and start with sales. How much of the pie reasonably can we walk away with, right? And this is where we can get into the weeds a little bit, okay? And we can kind of summarize with how profit first kind of ties into this. So really, a lot of what we want to do is say, okay, we have sales. Our entire bucket is sales, okay? Let's say $1 million. Let's say your company's doing $1 million in sales, okay? For a residential moving company, what we have determined, and this is something we've determined through Promover accounting, a reasonable gross profit margin, and we can talk about what that is 50% of sales, okay? So what gross profit is your total sales, right? Minus your direct inputs. Okay, what are your direct inputs? Direct labor, truck rentals, damage claims, fuel, overnight stays for your drivers if they're doing long distance or interstate or whatever, packing materials, things like that, right? Your direct inputs that you can directly associate with a sale, okay? What we like to say is you have $1 million in sales, half of that is probably going to be allocated to those direct costs, okay? So how much do you have left? $500,000, okay. Of that $500,000 now, you're only left with half of the bucket. Where do those pieces fit in, okay? And that's where Promover accounting says, okay, we have certain metrics inside the rest of this bucket that we want you to meet. Part of that is your take home. Part of that is 10% take home, 20% take home, right?
And even that's high.
And even that's high. You're right. Absolutely. Especially depending on different parts of the year, right? So at the end, though, we say after you pay all your overhead expenses, you already paid all your direct costs. Now we're down to overhead expenses. You paid all your overhead costs. What are you left with? 10%. Okay, well, we're happy with that. You can take that 10%. You've paid all your expenses, okay? Promover accounting will help clients dig in and say, okay, of this remaining 50% of the pie, 10% is going to go to advertising, 5% is going to go to truck repair and maintenance, 7% to this, that, and the other thing, 10% to administrative overhead or to administrative wages. And if you're left with 5%, net, you can't take 10%. There is no more, there's no more, of whatever's in your bucket to take, right?
Mm-hmm.
So that's where profit first throws us off is, okay, yeah, you want to take 10%, but so who is not going to get their piece? Are you not going to pay your drivers? Okay, good luck with that. Are you not going to pay your advertising? Okay, well then you're gonna shrink your sales, all right, which is more hurt you. So rather than say, okay, this is where we want to start, let's pay what we need to pay, we say, okay, we want to end with, say, 10%. We have 90% of the pie to allocate, and let's figure out how that allocates. Okay, so that's what we do monthly with our clients. We present them what we call the pro metrics, and they can look and they can see, okay, if 10% is my budget for advertising and I'm at 12%, okay, that 2% is going somewhere. Where's it going? It's probably coming out of your 10% target net. You're only walking away with 8%. Right. So yeah, I know we dug into the weeds there a little bit, and we can digress and maybe pick that apart a little bit. But ultimately, that's how we like to work around that profit first mentality. Is honestly, I love the idea, but it's really profit last. The owner always gets what's left over. We just want to make what's left over be as big as possible. So.
Yeah, I think for me, the way I incorporated it for my business, that has definitely changed the game. I think the way I was using profit first was for the buckets. So for cash flow purposes. So it's like, okay, you know what? We need profit. We need tax, to pay Uncle Sam. We need to, save up for claims or put aside for claims just in case we get them. So it was like freeing up the cash flow was the main thing for me to use. So I wasn't kind of like putting it together for like the P&L, but more or less for the cash flow statement.
Sure. Yeah. And that you definitely want to budget for the expenses you're going to have, taxes, like you said, claims, we prefer though to say, as long as we stay within our metrics, the cash will be there, right? Because you can't possibly budget for everything, though budgeting is a wonderful tool and it's necessary. Absolutely. But like you said, having those buckets or having that remaining cash flow, that cash balance to sustain whenever you're outside of your metrics is very, very important. And if profit first and that mindset allows you to get there, do it all day long. Absolutely.
Yeah, I think my financial controller, she was kind of like a little thrown off by it because she was like, I get that we want to split the money and have money going each way, but it's like now when you have some expenses, it's like, okay, hey, where do you pull that from? And that becomes a nightmare. We're trying to figure out which bucket to attack. And granted, I understand, like I said, I understand the P&L statement. And maybe we want that 20% on the bottom line, but now when you get that 20% on the bottom line, and let's just say that might be 19,000, 20,000, I feel like that 19,000, 20,000 isn't in my bank account.
Yeah.
So
you're right. You're 100% right, and we see that every day. Is there's too much month at the end of the money. I totally understand. And again, the big thing is tweaking the little pieces to make it all work. Now, most of what we see is business owners or entrepreneurs or whoever the business owner is getting paid too much for more than the operation warrants, right? And here's a really cool gem that I think you'll like. We like to say all of your labor should be under 45% of your total sales. Okay. And breaking that down further, 30 to 35% of your total sales should be your direct labor. Okay.
Oh, nice. And that's including taxes?
What's that?
That's including taxes? Or
yes.
Okay.
Yes. So that's your drivers, your crewmen, if you have somebody at your warehouse, those are your direct laborers. And then your admin take up 10%. Okay. Now, who's included in admin? Your salesman, your dispatcher, your owner, right? I think from what I see, a lot of owners try to retire too early. Okay. And not until you can either live on the net income of your company or the 10% of the total sales is enough to warrant you taking up some of that 10% with your salary and not working, you can't fire yourself yet, right? You still need to be a part of your company. Now,
so would you put the owner on the P&L, or would you rather the owner be on the balance sheet with a draw?
I would always, it depends. It depends. If the owner is absentee, go ahead and just take draws. Okay. And I'll explain why in a second. If the owner is actively involved, then they absolutely should be on the profit and loss. And here's why. If you would go to sell your company, and I'm analyzing your company, and this is something eventually, we can talk about as well, something that we're developing called the Moving Equity Group. That's going to be looking to purchase residential moving companies or partner with residential moving companies to grow them. But if I'm looking at your income statement or your profit and loss, we call it as well. If I'm looking at that and I'm analyzing, okay, how does this company work? How is it sustaining? Okay. And the owner is an active part of the business, of the day-to-day business operations, yet their wage is on the balance sheet, not on the income statement. They may have a 10% net income, and I'm looking at that and I'm saying, wow, awesome, this company's doing 10%. They're a well-oiled machine. Until I see the balance sheet and I see $100,000 of owner's draws for the year, and that's not on the profit and loss, right? That's not coming out of the profitability of the entity. And since it's not, it now devalues your company, and it also makes your balance sheet have basically zero equity. Everybody's pulling all their equity out. They don't understand how the positive building of equity is a good thing. It's a great thing, especially if you're looking to sell an entity in the future. So having an owner on W-2 payroll and having it come through the P&L, or having the owner take owner's draws, and take basically dividends, we'll call it. Our preference is dependent on, is that owner actively involved in the day-to-day operations, or is he, sitting on a beach in Maui and he, jumps on a call, once a week? Because no, that's not really a part of the operations, because a private equity firm that would purchase a moving company, that's what they're going to do, right? So they already understand that cost inclusion when a moving company would liquidate. Okay. So yeah, that's our opinion.
Makes sense. And I think, obviously can't go too far into this because of, tax ramifications and stuff like that. But it's one of those things where I think, if you're going to get taxed anyways for, based on the profit, I think it's like 15% off the profit, and it's based off your reasonable wages. If they're not going based off of your W-2 income amount, and they're only going based off of what's on that bottom line as an owner's, I guess, what do you call it? Owner's profit in your business. Let's just say that. So those words. I find that weird. I find like, well, hey, you know what? Why get taxed by Uncle Sam twice? I feel like.
Sure. And that's something great we can talk about too, is there's really three big tax forms predominantly associated with the movie companies we work with. And that is an 1120, which is used for a C corporation, and 1120S, which is used for an S corporation. We can talk about that in a little bit, and the benefits of that, or just your regular personal 1040, and it would go on something that we call a Schedule C of your personal 1040. Okay. And what you're talking about specifically is with an S corporation. Okay. And how that works is all of the net income generated from the S corporation flows over to the owner's personal 1040 through what's called a K1. Okay. Mm-hmm. And that K1 basically says, hey, this moving company generated $100,000. The moving company doesn't have to pay any tax, because it's a S corporation. It's not really anything. It's just separated for liability. But the owner of this S corporation does have to pay tax on its behalf. Okay, that $100,000 is taxable revenue. I'll say, and the reason I'll say taxable revenue is because it's not a taxable wage, right? With an S corporation, the money that flows over to your 1040 is not subject to payroll taxes, okay, which which can add up to 15.3%. So that $100,000 that you earn from your 1120S through your K1 onto your personal 1040, you're basically reducing taxes by 15.3% by doing that. Okay. Now there are, and we don't have to get super into the weeds just because there are some tax things we have to be concerned with, but part of that is the owner does have to have a reasonable wage, which, that's up for speculation, kind of what exactly a reasonable wage is. And again, that money that's flowing over has to be from an 1120S or an S corporation, right? Whereas like a Schedule C, or not a Schedule C, an 1120 or a C corporation, that C corporation is an entity, is a taxable entity. That C corporation pays tax on the $100,000 of net income that it earns after depreciation and all the adjustments. And then any money, again, in a C corporation, any money that an owner takes out of that is basically dividend income. So they have to pay tax on that. So you're absolutely right that it's better from a tax perspective to pull draws from an 1120S, an S corporation. It's absolutely better. But then again, if you're looking at your metrics aren't going to be accurate.
Gotcha.
So your metrics aren't going to be accurate, and it can screw up your 10% administrative wage. Because that's a question we answer all the time: is my net income strong, but there's no money in the bank account? Well, what's going on? Well, you're taking it all through owner's draws, and that doesn't show up on the net income. Mm-hmm. So yeah, there's a lot of different ways that can go.
Yeah, it definitely gets crazy, because even then, like if you got loans and all that other stuff, and the loans pop up on the balance sheet and not the P&L statement, I know the interest carries over. That's if you are actually breaking it out, which people won't.
Correct.
But I feel like that right there is like, well, hey, I made a 20% net profit, but then I'm like, well, I don't see that money in my bank account. Now you look at all the expenses on your balance sheet and you're like, oh Lord, there you go.
Yes. And that is the most unused and unreviewed statement, is the statement of cash flows. And it's kind of difficult to understand. It's really weird. You start looking at it and it has changes to AP and changes to AR and fixed assets and owner's draws. It has net income. It has everything. And it's kind of weird to understand, but it's basically saying at the beginning of the month, your cash balance was here. And at the end of the month, your cash balance is here, right? And we consult with a lot of clients over the statement of cash flow and reviewing the statement of cash flow. It's one of the statements we put into our monthly reporting and our pro metrics every month because it's so important, but it's super underutilized, and a lot of people don't understand it as you do understand it, which is unique. A lot of moving companies don't. So kudos to you.
Yeah, I think the statement of cash flow, because I was referring to the balance sheet, but the statement of cash flow is powerful, and I know that like Mike Wachowicz would say is like, hey, look at your bank account, and that's what you really got.
Yes. Yes, you're right. And here's the issue: is on an accrual basis, it's absolutely not what you got, right? Because especially if you have payables pending, okay, let's say you have $50,000 in your bank account, and it's we're in May 31st. 31 days in May?
Yes, I just seen that.
31 days in May. So you got $50,000 in your bank account. However, you have 5 loans coming out tomorrow, and maybe the interest is $1,000, but the principal's $10,000, so there's 10. You have payables that you wrote checks for that haven't come through your bank account yet, and that's 20. So really your bank account's only $20,000. Mm-hmm. But you're looking at it and you say, oh, I have $50,000 to spend. Well, no, you do not.
Don't touch that money.
And that's where a lot of people get screwed up. So that's why we look at the statement of cash flows paired with the profit and loss statement, paired with the balance sheet. You got to look at them all together.
So I guess the question would be is like, for someone that wasn't so in depth with like the numbers or so like that, could they create like a statement of cash flow where it says, well, hey, you know what? These are my bills. These are things I have to pay. So if I go into the month with this and it's allocated across all of these different chart of accounts, would, that be kind of more accurate for them to see maybe what their end balance would be?
Absolutely. Getting started, especially smaller residential moving companies, not a lot of them receive payment on accrual, meaning most of them get paid when the job's completed, right? So
Yeah.
it's not like you have a 30 days where you're waiting to receive your money.
Hmm.
And they have very small payables, meaning you don't receive an invoice and you have 30 days to pay it. Most of the time you're just buying supplies with a credit card today, or your debit card or bank account, or a check today, and the money will come out of your bank account today, tomorrow, or a week from now when they cash their
Yeah.
check, right? So for residential moving companies that are just getting started, yes, that's where, honestly, and this can get you into trouble, so don't say that I said it. Credit cards can be a wonderful thing. You need to pay them off every month, and you should not use it more than you can afford. But debit cards are very, very bad. We very much tell everyone to not use debit cards. ACH can be okay, depending on who the vendor is. But if you are using a credit card or you're using ACH transactions, your bank account, it's pretty easy to go back in time and say, okay, my insurance is $1,000 a month, and it comes out on the second of the month. Guess how much money I'm going to be paying on the second of the month next month? $1,000. It's relatively easy to go back and kind of build a projected statement of your overhead costs.
Mm-hmm.
And then again, if you know what your gross profit is, and you know that your gross profit's 50%, okay, let's say you go back through and you analyze your overhead cost, and it's $10,000 a month. Your administrative, you have an outsourced administrator, you have insurance, you have, all these overhead, advertising, all these overhead expenses add up to, say, $10,000 a month. Okay. Your gross profit, you've priced it so that you're walking away with 50% of, gross profit. What that means is then you have to have enough sales. You have to have double the sales of your expenses at that point. So $20,000 is your break even. Okay. Break even is something that's very, very powerful, because now, if I sell more than $20,000, I'm walking away net positive, right? So $20,000 now is my minimum, because again, we said that $10,000 is your overhead. And if you're walking away with half of what you make, because the other half is going to gross profit, that's how we determine that $20,000 is your overhead. So $20,000 is your break-even cost, sales. So break-even is very important. But again, you kind of have to evaluate it all the time, because it might be your gross profit may be 45% one month and 55% the next month, depending on how your payroll falls, right? So number one, if you're big enough, get an outsourced accountant to do it for you.
Right.
It's a lot.
Yes.
It's a lot. And these moving company owners, most of them are salesmen, and it's wonderful. If you're an entrepreneur, you are a salesman first, and outsource everything that you are not the best at, right? So
Makes sense.
that's what we recommend.
So I see you say 50% for COGS, cost of goods sold, for those that didn't know. So what would you say is that area for general expenses and net other incomes?
Yeah. So great question. So let's say we're looking at the pie again. Okay, your whole pie, and 50% of your pie is gone, right? Because it goes to direct expenses. You're left with 50% of sales then to cover your overhead, right? So how much do you want to walk away with? Let's say you want to walk away with 10% of your sales. Well, then you only have 40% left of your pie to go to expenses, overhead expenses.
Gotcha.
And that's what this ProMetric does, is we say, okay, well, how much should that be? Well, on average, your admin labor is 10%, your repair and maintenance is 5%, your advertising, say 5 to 10, whatever. If you can go back, if you can budget for those percentages and stay within those percentages, then you're guaranteed to walk away with a net income. And it might fluctuate between 2% in the slow season to 20% in the busy season, but as an annual average, we want to see, say, that 10% range, right? So that's how we use metrics to determine, okay, based on our total sales, how much money do we have to be able to afford our overhead expenses, as long as our gross profit's right?
Gotcha. So should a person, obviously we know we won't walk away with the total 10%, because we just mentioned how there's some expenses on the balance sheet that we are not considering. So should we budget for 12%, 13% so that basically we can come away with hopefully 10%?
That's a fantastic thought. And yes, we like to say about 15%, because then you have that other percentage to pay down, whatever expenses that are going to come up, or not even expenses necessarily, but maybe capital expenditures that are going on your balance sheet, to cover those costs that are not on your P&L. Now, something to remember also, though, is yes, you might be paying $2,000 a month for a truck loan, but only a piece of it is interest, right? Maybe $500, $700 of that is interest, and that's expense that you're never going to get back. But the other piece is principal, and that piece that you're paying on that truck, you are getting to own that piece of that truck. Now, while that truck does depreciate, not in the taxable sense, yes, but also in the value terms. Every year this truck's going to be worth less and less. Every mile the truck's going to be worth less and less. Yes, that is depreciating, but that $1,500 maybe a month that you're paying in a loan payment, not all of it is going just to expense. It's going to actual equity, and increasing your equity in this transaction, or in this item. Because also what a lot of people don't understand is, okay, say you have a 7-year term on a truck. You buy a new truck, 7-year term. Once you pay it off, you have equity. That's what we would call equity in an asset. It's fully paid off. You own this asset, and this asset is also leverageable. So if you're looking to get a bank loan, or again looking to sell to a private equity firm or another residential moving company, they can go in and say, okay, when we buy this, we're going to leverage this to pay you off, write you a check with it, or capital infusion. Maybe we can get a loan, and then that helps us weather the storm of, the past few months that are just a little slow, right?
Gotcha.
So equity, I digress, but equity is a very important aspect that a lot of people don't understand, and you're reducing it every time you're taking that owner's draw as well. So
yeah, no, I realized that. I definitely realized that with the owner's draw. I was also thinking, like, so for lease vehicles, you wouldn't, even though it has a depreciation schedule, you wouldn't count that as a kind of depreciating asset, right? Because it's a lease.
So it's going to depend on the type of lease. Most of the time, leased vehicles, you're just expensing the lease. Most of the time, you're just expensing it. Again, depending on the type of lease, if it's a capital lease, it's going to be a little bit different. But most of the time, you're just expensing the lease. Leases is where a lot of people get tripped up on. A lot of people long-term lease or rent trucks when they first begin, and you're going to have to rent trucks eventually, especially if you're doing 2 trucks in January and 5 trucks in June, you're going to have to rent trucks. But the longer you can stay away from rented trucks, the better. Every client that is renting trucks just has a hard time covering that rent. It's just a lot of money, So if you can try to even out your sales throughout the year, maybe increase your marketing budget through the slower periods, and then, keep it similar or even reduce it maybe during the summer periods, just to maintain an even level of staff and even level of truck requirements. It'd be really nice to have long-term leases. They're substantially cheaper, or purchases are even better. We really like purchasing a good truck. But yes, to answer your question, most of the time, ask your accountant, but most of the time leases are expensed. So.
Oh yeah, definitely. I would say that we definitely realized that we wanted to get away from rentals, because one year I think we was paying U-Haul like $35,000 for the year.
Yeah, and that's half of a used truck, or a third of a relatively new truck. You know what I mean? Sadly.
So I used to think of it as a pass-through cost, because I'm like, well, what if you got to cover maintenance? What if you got to cover these things that just make you just want to, puke because of how expensive it is.
And it's very, very important to get good trucks. Again, don't take my word for it, but we've seen a lot of success in Hinos. Hinos are kind of like an underutilized truck. We see a lot of internationals, a lot of Freightliners, most of the time a great truck. honestly, a lot of what we're seeing and recommending is Cummins and Allison. Cummins motor with an Allison transmission. We're happy with those most of the time. And I know I believe recently International is switching to Cummins and Allison, which is nice. And maybe that's select. But those are some well-built machines, the Cummins and the Allison. But the other piece too, when we're talking about that 50% gross profit margin, is a lot of people think on that 50% gross profit margin, or whenever they're creating their prices and determining that that's going to be enough, they're thinking about their leased costs, right? Well, if your rental cost is double, your gross profit is no longer 50%. Maybe it's more like 45%. Or maybe it's more, maybe your gross profit's more like 45%. And if you only had a 5% net projected anyway, now that net's gone and you're break even or losing money. So if you're renting trucks,
that means you're going to spend like more like 55% of your COGS because of the rentals?
Correct. Yeah, because since rentals are costing more than your long-term leases or your purchased trucks, if you're sitting down and calculating what your metrics are and determining, okay, I'm pricing my services so that I'm walking away, say, with a 50% gross profit margin, which is what we want to see. Now, instead of using a lease truck, it's during the busy season, you rent a truck for a job. Now your gross profit may be more like 45%. And your COGS may be more like 55%, right? Mm-hmm. And if you were projected to have a 5% net, right? Mm-hmm. Now that your cost of goods is 55%, there's a smaller piece of the pie left to go for your overhead and your net. So now your net may be zero or negative. And that's where we see a lot of people struggling is, maybe their gross profit's 50%, but their overhead cost is too much, or they project their gross profit to be 50% and rental trucks or something is reducing gross profit, again, increasing cost of goods. A lot of people can get tripped up on that. So oftentimes we do not recommend rentals unless it's kind of a last resort thing. So kind of a unique way that we've been looking at this as well is to actively encourage our moving company owners to try to even out their schedule throughout the year. And rather than focusing on super heavy marketing during the summer months, spend that marketing during the slower periods and try to be able to retain your staff during those slower periods and your trucks. Because going from 2 trucks to 5 trucks, 2 trucks in January to 5 trucks in June, that's a hard jump, right? Mm-hmm. It's a little bit easier when you're going from 3 trucks to 4 trucks. And maybe your June's not as big, but it's a little bit easier to manage your staff that way. You can have longer term staff, which is great. Staff retention's huge. So we've been encouraging our clients to say, to allocate some of that advertising budget into some of the slower periods to increase their workloads during those periods.
So take away from some of the marketing, you're saying?
Not necessarily take away, but redistribute, right?
Okay.
We almost never, as a company grows, what we've kind of seen is once a company's at, say, 2, depending on the market, but once a company's at 2.5 million, 3 million in sales, 10% of your sales is too much to allocate to marketing. Most of the time you're throwing it away.
No, that definitely makes sense.
Right. Maybe more like 5% at that point. And then contrary to that, if you're at 500,000 in sales, maybe 15%'s okay.
Yeah, because what is that? You said 2.5, so that's what, 250,000 approximately, 10%?
10% would be 200 at 2.5 million, $250,000 a year in advertising. A lot in marketing. Which is a lot, too much, too much. Unless you're really trying to grow, or you're trying to grow another target location, to the next city over, there's extenuating circumstances that are going to change that. But for the most part, half of that, 125 grand, I'd be happy with that.
Yeah, that makes sense.
Yeah. Okay. Good marketing. Yeah.
So what if, I guess we'll go into the topic we want to go into initially, but before we cut out for today, but the one question I have is, what if if a company feel like they're too big to redistribute their expense? Like if, like, oh man, I done cut everything that I could possibly cut, for this recession going on.
Yeah.
How can we try to get back on the positive side without making too many more cuts?
Yes, great question. And it stems from a number of factors, okay? The way that we set our targets, anyway, we know that it's accurate. We know that it works. We take our pool of all the moving companies that we own, we take out some of them that are unique. Maybe they focus a little bit more on van line revenue, which kind of throws off some of our margins. So we take out those companies, and the remaining companies, we create these averages, okay? So we know that they work, we know that they're accurate. If you are unable to reduce your expense, and your direct wages, including your own wage, the owner's wage, are not too high, and they're within the margins, or they're as low as possible, then the only thing you can change is your revenue, your amount of revenue. And there's two ways to do that: get more or increase your prices, right? And sometimes our expertise, what we advise, sometimes it's, hey, you're doing too many moves. You need to increase your price and reduce the number of moves you do, right? And then sometimes it's opposite. Hey, you're way too low, and you're way too low in price, or you're way too high in price. You need to reduce your price and increase the number of sales you're doing. If you're at a 65% gross profit margin, you're probably too high. Either one, you're too high, or two, your accounting's wrong. Could be that too. But if you're that high, then something needs to change. Something should change, because you will have better metrics, maybe by reducing your price, right? So it really depends on how the company is structured and what they're going through. And again, that's really what we focus on with the Pro CFO or Pro Mover Accounting CFO services, is once you understand where your metrics are, right? You have accurate bookkeeping, you're looking at your metrics, but you come to the point where, what in the world's going on? I know my metrics are good, but I can't figure out why I'm not making money. That's where the CFO services come in, where we're analyzing your cash flow. There's a bunch of different pieces to that, but we're analyzing your cash flow. We're analyzing the vendors that you use, how much you're paying them, how often, right? We're looking at your bills and how often you're paying your bills or your accruals. How often are you receiving the revenue? Are you receiving it on time? We really dig into the nitty-gritty part to say, okay, yes, the metrics may work, and you may have reduced all the expenses that you could, but this is the piece that's missing, right? So you can dig as deep as you want, but again, it all stems on having accurate reports to begin with, and that's most of what we see is people saying, hey, I reduced everything I could. Well, when we take a deep dive, there's a lot more that's pretty gluttonous. Right?
Yeah, definitely. I think my controller hit me with the debt to income ratio number one time, and I was just like, I always knew what it was, but ask me how to calculate it, you got me.
Yeah.
But I was just like, oh my goodness, is it that bad, or is it that good? I'm like,
I know. Well, and debt can be a killer. There's a lot of people that hate debt, but debt can be an incredibly powerful tool as well if it's used correctly. Now this day and age, it's making it tough with 7 to 10% interest rates. But debt is a very, very powerful tool. Again, consult your accountant or CFO on this, but 9 times out of 10, we recommend a client to go into debt to buy a truck if the terms are good versus get a long-term lease. Most of the time we do. And when a lot of people are calculating the difference between purchasing a truck and going into debt or getting a long-term lease, a lot of people forget that you're building equity when you're in debt. When you're in debt and you're paying off debt, you're building equity in that truck, as opposed to paying money on a lease. Yes, you might not have repair and maintenance, but if you get a good vehicle, your repair and maintenance better not be a ton. In all the analysis I have done, this is just my opinion on my own analysis, which may or may not be flawed. I have seen purchasing good trucks is vastly more beneficial than long-term leases or definitely renting. So you have a good sustainable business. We want you to be purchasing trucks. So
Gotcha. It makes sense. Okay. So I know that, oh man, we've been dropping gems all this episode.
good. Hey, all right.
So, we're definitely gonna have to invite you on another episode because I know there was some stuff that we didn't even go over yet.
Yeah.
But yeah, did you want to say anything before we take off?
No, well, if you need anything, if you need, just somebody to review things with, call it Promover Accounting. We really try our best to give the clients the information they need to make educated decisions is really our MO, and you and I have had wonderful conversations about some of this stuff, and you're really up on your finances, which is really awesome, Dwight. And how important it is,
Oh yeah.
So that would be my big thing is if any of your listeners are just struggling to calculate the items, or they're looking for residential moving company specific bookkeeping, financial analysis, tax, go to our website, promoveraccounting.com, give us a call. We'd love to chat with anybody who's looking for that service. So
awesome. So you're definitely going to be in my directory on my website, everybody. So maxmovingtraining.com. If you look at the resource section, we're going to have Brock Hartzler
he was last time,
there as Promover Accountant. So, you can definitely find him, go to his website. He definitely knows his stuff when it comes to this number guy, everybody. So, definitely chime in. This is the man to speak to when it comes to those numbers. I'll definitely be calling you myself soon. Definitely get some consultation for sure.
Good deal.
Anything else?
Yeah, thank you so much, Dwight. I love what you're doing. I love what you're doing with the podcast and with your trainings, man. Awesome service. Thank you for doing what you're doing. So.
And we're gonna look to have Brock on our morning show. I know 8 a.m. Eastern is a little early, but yeah.
I'm up on it. I'm ready. I got a little 2-year-old girl, so I'm up anyway. So
all right, awesome, everybody. So all right, y'all take care, and we'll talk to y'all soon. Later.
Thank you.